The RBA turns more hawkish, saying it considered a rate hike, but not a cut, when it met yesterday. Weak US retail sales give hope for 2 Fed rate cuts this year, and strong European services inflation sees ANZ change its call for ECB rate cuts in 2024. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ New Zealand economist Henry Russell continues his analysis of sticky domestic inflation and how worried it might be making the Reserve Bank.
We favour the timing story, but if a lot of this persistence actually reflects structural factors, that presents a significant challenge to the Reserve Bank.
But first in 5 and 5 with ANZ. Overnight, US Treasury yields and the US dollar fell, and stocks rose slightly after weak US retail sales pushed up expectations the Fed can cut twice this year. The Aussie dollar rose. It was supported by Reserve Bank of Australia commentary as it held rates at 4.35% yesterday. But as ANZ Head of Australian Economics Adam Boyton explains, the statement with it was more hawkish than expected.
Firstly, a paragraph that discussed, recent data and the implications of that data for the RBA's forecast that they published in May. Interesting thing there was a bit of an upside risk skew, if you will. So everything considered, while the data have been mixed, if anything, the risks were a bit skewed to the upside. And then in the final paragraph, they put in the word reinforced, as in recent data have reinforced the need for the board to be vigilant against upside inflation risks.
As of 4 a.m. Sydney Melbourne time, the US dollar index is down slightly and the Aussie dollar up 0.6% at 66.52 US cents. The Kiwi up 0.2% at 61.41. Number 2. RBA Governor Michelle Bullock says the board considered a rate hike, but not a cut at this meeting. Adam says it's clear the RBA is in no hurry to cut rates.
The key thing that the board is holding out for is to see some signs that inflation is going to get back to the target and stay there. And in that regard, the governor mentioned a few times in the post-meeting press conference the importance of the June quarterly inflation number. We do have, of course, a monthly inflation indicator in Australia. It's not as complete as the quarterly CPI. And so the governor did say a number of times that they'll be looking at that June quarter CPI, and that's quite important for giving them a better feel on where the broader inflation trends are at.
Number 3. US retail sales rose 0.1% in May. That was below expectations. Growth in previous months was also revised down. That led traders to lift their expectations the Fed can make 2 cuts this year. Here's ANZ Head of G3 Economics, Brian Martin.
Clearly, the retail sales data show that demand in the economy is softening. And I think that if it continues through the second quarter, will provide the FOMC with comfort that in totality, the data now is beginning to fit with a more benign inflation backdrop. 5 months now of retail sales growth of 0.1% does suggest that the consumer is beginning to feel the strain of high interest rates.
Number 4. Final European CPI inflation came in steady at 2.6% year-on-year in May. Services inflation of 4.1% rose from 3.9% in April. Brian says that services inflation is being backed by recent wage growth and expects the ECB will take notice.
We therefore have scaled back our expectations for euro area rate cuts from the ECB and now anticipate 2 25 basis point rate cuts in the second half of this year, 1 in September and 1 in December. Now, in total, that would mean that you're getting 3 rate cuts this year. So the ECB is definitely, we think, embarking on an easing path. But it's not going to rush into rate cuts.
Number 5. May CPI data for the UK is due later today. ANZ economist Bansi Madhavani says the headline rate is forecast to fall to around 2%, but the Bank of England will be watching services inflation, which has been near 6% for the past few months.
The disinflation in services CPI is what is important for the Bank of England to get confidence that 2% target can be sustained. Now, Bank of England's own staff estimates suggest that services CPI will moderate to 5.1% by June and 4.7% by September. We would be interested to see if services CPI trajectory is indeed in line with these projections or if it turns out to be more sticky.
Bansi Madhavani there. Now, in our bonus deep dive interview, ANZ economist Henry Russell has been looking at New Zealand's sticky domestic inflation and whether recent strength will unwind, or is due to more worrying structural effects. Here he is discussing local authority rates with my colleague Alex Tarrant.
It's a catch-up effect playing out here where councils are responding to past inflation outcomes. But the flip side of that is there is a structural element here too, potentially. Councils are facing significant infrastructure challenges in New Zealand, and so that is adding to funding pressures. It's not that the Reserve Bank can't do anything about this. It is these increases, in part at least, reflect past inflation outcomes, a period of high inflation. And so now with inflation falling, pressure on councils for delivering goods and services, particularly wage pressures, are now starting to ease. So the outlook is more positive, but certainly there are structural drivers here that do matter.
And then just tell me why have you got cigarettes and tobacco in as one of your four reasons here? Yeah,
well, cigarettes and tobacco are running at over 10% year on year in the CPI currently, but the bulk of that increase reflects the tax component for tobacco. The tobacco excise tax is indexed to past inflation outcomes. So this plays in directly into the timing story that we're telling, and that inflation has been high for some time, and that's still flowing through in this indexation to past inflation outcomes in terms of some of the components in the CPI.
And then finally, rents, Henry, are in there as your fourth key driver of domestic inflation.
So certainly there's been significant pressure in the rental market in New Zealand over the past couple of years. The thing about rents in the CPI is they are a very slow-moving beast in terms of how they're measured. And so the sample size for the CPI measure of rents is actually 8 to 10 years. And so it does take a long time to reflect changes that are occurring in the rental market. And if we look at new tenancies alone, new tenancy inflation peaked at over 7% at the end of last year. It's now down to 4.2% and still falling. And crucially, it's below the CPI measure now, which does signal that the dynamics in the rental market are turning. So when we look at the new tenancies data and we're seeing this shift, the challenge is that that tends to take about 9 months to actually be reflected in the CPI measure of rent. So that is certainly likely to see the rent component of inflation remain robust across the rest of this year.
And so just incorporating all of that, what are we going to see, say, over the next year?
So if you think about the four drivers that we've just run through, they have a weight in the CPI of less than a third. Currently, they are contributing nearly 40% to non-tradables inflation, and that's still rising, and as we expect it will peak above 50% in Q3 this year. So there's still that persistence coming through, which is potentially going to mask some of the disinflation progress we're seeing as the labour market loosens. Certainly if you look at ANZ's Business Outlook survey, inflation and wage indicators, the forward-looking components of those are certainly moving in the right direction now. And so we are confident that disinflation does lie ahead, but the challenges with some of this persistence, which is already baked in, is likely to see domestic inflation continue to print strong over the coming quarters. Look, there is a lot of uncertainty about the inflation outlook, and so certainly we favour the timing story, but if a lot of this persistence actually reflects structural factors, that presents a significant challenge to the Reserve Bank.
Henry Russell there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, June the 19th. Get you tomorrow with that UK CPI data and a look ahead to the Bank of England's rate call. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.